Close's stock picking has been positive, as has their short duration positioning and being overweight equities and underweight fixed income. Close have a 50% hedge back into sterling as protection, which would benefit should we see sterling start to strengthen. The US dollar is around 64% of the global reserve currency base. However, the euro is 20%, so movements here could also have a large effect. Inflation is a worry if we see more protectionism. Close feel that interest rates are rising, but they see more modest wage inflation. They do not see a sharp rise in inflation. They feel that property adds to diversification and is an area Close have not liked for a long time. However, be aware it is equity, not direct property. They see property as an inflation hedge. Originally, the funds were positioned skewed towards equities, but now Close are looking towards more of a balance of equities, bonds and alternatives. The income fund was up 2.1% in February. Over the month, duration has been reduced from 4.8 years down to 4.3, and the fund is yielding at around 4.26%. SEI continue to offer solid performance. They have introduced a new US small cap portfolio manager and are also still looking for a new global frontier market manager. They see earnings in the US potentially pushing higher and feel that cyclicals should benefit. This is an area SEI are overweight. They see healthy inflation in the US and do not believe inflation will become out of control. They feel the US economy is robust, expecting it to stay that way, and that sterling may strengthen slightly over 2017. Schroders' view on the US dollar is at odds with their recent purchase of gold and their holding of gold miners. They see gold as a hedge against a short-term spike up in inflation. They also believe that the US market and the US dollar is an overpriced reserve, which may tumble. Gold represents a hedge in that event. Now, with regards to Trump, he is expected to speed everything up. Economic growth will lead to inflation. Inflation will lead to a rise in interest rates, and higher interest rates may bring forward the next downturn. If Trump was happening at the beginning of the cycle, then it would be very bullish, as he is happening at the end of the cycle. Whether he will hasten the end of the cycle or prolong it is the big question. The True Potential Threadneedle Monthly Income Fund was the top performer within the growth risk category, returning 4.3% over the month. As a UK fund, Threadneedle are conscious of how Brexit plays out, but feel that holding a quality portfolio of stocks is the best way to navigate through potentially negative events. Domestic companies have been weakened post-Brexit, and this is likely to throw up opportunities. Looking at Europe, they are wary of political uncertainty, particularly in France. With regards to sterling, other than a short-term wobble around the triggering of Article 50, they think that the pound is close to its lows and due a rebound, so are looking to reduce overseas earners. The fund is currently yielding around 3.5%. 7IM are relatively constructive of economic growth, see dislocation in currency markets, seeing opportunities in US small cap, but valuation in the US relatively high. 7IM don't expect Trump's fiscal spending to start until 2018, with inflation not coming through until a year later. The key diversifiers within their funds are alternatives such as their inflation-linked note and their dispersion trade. Within equities, Europe is undervalued, currency is low. Japan is also a big bet for 7IM. US small cap, India and banks for the higher risk funds are the areas which 7IM see opportunities to generate returns. UBS has been the big performer this month, with the greatest return seen in the aggressive category, as a True Potential 7IM aggressive fund returned 3.85%. Looking at positions, UBS are overweight value, and that is specifically Europe, Japan and emerging markets. UBS have mixed views on sterling, with short-term fair value being around 1.35. However, over the very short term, you could see the US dollar move even stronger. UBS do not have a UK bias, as many UK-based funds do, and will not add to the UK purely to have a bias. UBS favour the US over the UK, with the US looking fully valued but not overvalued. They feel that the minimum volatility and RAFI products complement each other and provide a good balance of risk. Turning to Allianz, Allianz can react very quickly to how events may change markets and can add or reduce risk depending on the levels of volatility within markets. Allianz favour Europe based on relatively cheap valuation and supportive valuations. In terms of duration, they are neutral to overweight. On the UK, the risk that inflation will tick depends on how much price will pass through. Wedge is facing a downward pressure from services, real PPP falling and therefore sanguine on UK gilts. For the True Potential Goldman Sachs Income Builder Fund, there have only been modest changes over the month. Looking at what areas are the most attractive, Goldman's prefer, in order, equities, credit, then rates. Over the last 6 months, Goldman's have been gradually reducing their underweight to equities. The US and Japan are their preferred areas within equities, but they feel that Japan is too low yielding. The yield of the fund is 4.3%. Within fixed interest, they are favouring the higher quality end of high yield, looking towards high BB or B. For Goldman Sachs Dynamic, volatility has been low, and Goldman's have seen a good performance from equities since the US election. Looking at bond duration, Goldman's forecast 3 hikes in US rates this year rather than the market's 2. In the UK, we have seen positive economic data, but not a lot to keep yields low.